What's up, everyone? I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day forecast here, update, recap, whatever we're calling it these days, for August 12th, 2021. Today we had our news release. The WASDE report sent markets in a helter-skelter, particularly more so for beans. Finally, surprising the trade with a yield estimate I think we can all get behind by the USDA, coming out at 174.6 bushels per acre. That was right in line with where we felt the actual number might be. Remember yesterday's video, we talked about how analysts are putting out all their best guesses to see where the USDA would peg that number here today. But shocking the trade, because none of us have any faith that the USDA will throw one the way of the farmer, which is ironic because the last year we've seen almost every report be bullish against trade expectations and go the way of the producer. However, price action today wasn't the best. We did see, obviously, a positive green day in both corn and beans. Beans settling up a penny when it was all said and done. Corn in the December contract settling up about 12 and a quarter cents there. Not bad. Obviously, positivity was great to see. But what I did not like seeing was how we passed through some technical levels and faded back into trading ranges, particularly for soybeans that we'll look at in a minute. Soybean yields were only reduced down to 50 bushels an acre, down from 50.8. Trade was expecting 50.4. When you weigh that against some of the cuts we saw in demand and what have you, didn't do much on the balance sheet, but still was a slightly bullish trade and worth being up a penny on the day. I would argue that that's actually a fair place for the soybeans to have closed given its report. And I see the rally in the soybeans was much more of a sympathy rally alongside the corn because now we're starting to talk about corn production really coming down to levels that I think we can all agree it maybe should be at, maybe even lower. We'll see how the Pro Farmer Crop Tour turns out over this last week. Do be in touch with us. We got our own Ted Seifried out in our chief market strategist and president here of the Ag Hedge division over here at Zaner. He'll be on that crop tour in the Western Corn Belt. I believe he hits parts of northern Iowa and then heads up through the Dakotas. So he's really going to see some of those problem acres and be able to tell us and report back as to how bad things are. I can already tell you from some of my clients' talks with other people throughout the industry, there's obviously a lot of corn acres up there that have been stressed. And I think maybe the USDA finally overlaid some of those drought maps with our growing regions and saw what kind of year we're actually having. Okay, that all aside, because we'll be doing a WASDE webinar here in a few minutes, sometime just after 3 p.m. If you haven't signed up for that already, I'll throw a link in the comments section here. But you can always shoot me an email, whatever. Hey, Dan, where is it? We'll try to get it posted up here too. But we'll be, Alex and I will be going over the numbers today, where corn, wheat, beans all settled out from our WASDE report and giving you a brief rundown on that report in a bit. But today, I wanted to just quickly dive into the charts, kind of update some of the thoughts I had from yesterday, where we stand today. Remember, yesterday I was pointing out how volatility was really low. We were looking for this market to go one way or the other here today. I favored a little bit more of the downside here. We might still get that downside price action with the way we faded off. We'll look at that in a minute. But the truth is that volatility, buying a call or a put, short dated, something really close to the money, was very cheap to do and could have been a profitable trade depending on how you played that here today. But what we knew, without knowing exactly what direction the market would go, we knew today could be a starter pistol or some kind of volatile day that would create some market movement, right? So remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today, just my own opinion, not a direct trade recommendation. So let's talk today and start with December corn. Big mover, real quick one. Real quick mover on the open there, not on the open, excuse me. Went up to fill the 558 gap that we talked about yesterday within the day session. We came all the way up, and I feel bad taking it off the chart already. I shouldn't have before this video, but that 578 gap, man, we were like a magnet up to that level. We did go through that trendline resistance that was right around 580. We went through the highs of August, which were not at that level here. They were at, there we go, 565 there before. We closed above the previous high of August here on the day, which was a good move. It's certainly progression higher, but I don't like the three-wave nature of this market that traded, by the way, in 3 legs up if you measure this first leg up, take it down to where we had maybe some kind of triangle, we really traded right up into that 596, 100% or equal legs extension. That is not a very bullish wave structure. This would be considered corrective. And when you take a step back on corn, maybe this is all still inside of a much larger, range still. And if you want to call this an A, B, C, D wave correction, we'll still get an E wave lower to test somewhere in the 540 to 520 area before a major rally higher if this is some kind of Elliott wave triangle. But with all that being said, breaking above this trend line and then closing back below has me a little concerned. We also closed below this prior high that was into that late July, where we failed to fill that gap initially at 571. Take that for what it's worth, but it was still a positive day, closing up 12.25 cents in December corn. I think we can all agree it definitely should have been a green close from today's bullish report. Now, fading off 23 cents off the high, not a good look either. So if we start to see a decline here back below 565 and into the old trading range, I would have to consider this a very failed breakout of this market. And not to say that we can't find support somewhere down in the 530 to 540 range, but we would very likely be heading down to try to take out those lows for the month of August, which at that point, the market's just trying to cause the most pain to the most amount of traders. This spike rally sucked in a lot of longs. Now it squeezes them lower, tries to knock them out before maybe heading higher here. In harvest lows, at that point, we could consider all, a part of some larger bullish triangle or price action. Now, we still could break down and test down to the $5 to $5.80 area. That's not out of the question just yet. But every day now we spend above 560 to 570. That type of idea will slowly fade away, and we'll start to consider this trend, a market that is now trending higher. I'm also now going to continue to watch a channel in corn here that is forming now that we are trading higher in a progressive structure, somewhat higher. But we are going to need to push above this 595, 594 area, test $6, maybe even get up to 610 before we really feel comfortable that there's a breakout happening, because no matter which way you slice this, unfortunately, it is still a big range that we've been in since last April. So a little worried about the fade we've seen. If this fade picks up into the overnight and we fade away back down, watch this 565 to 555 area. A break below that area at this point it would be a great time to really think about having some downside protection. And hey, on this spike up, if you're in the camp that wants that type of protection, now all those puts and some of those things we talked about yesterday are a lot cheaper to look at. There's really not much I would do here with the exception of watching the 551 area, today's low, as a line in the sand. We can be bullish above, bearish below that line now that we've cleared out the books and kind of headed higher. So taking a quick look for December corn, we did just, continue to hold that 100-day moving average. So watch that as a very good indicator for this trend higher. We've been above the 100-day moving average with the exception of a couple little tests below it now for almost a year. We had to go back to August 12th of last year. That is amazing that we've been above the 100-day moving average for an entire year now, and the market's remaining above there. So that, to me, seems to be the technical indicator to watch for a bullish above, bearish below line in the sand on the larger time frame for December corn. And again, we're bullish above that level at this point. I'm going to remove this old trend line that we, kind of broke above. Obviously, we're still in a range. There's other levels to watch and to consider here, but 100-day moving average at 546 and rising. It'll probably be up to 551 here in a couple days, given the recent price action we've seen. 200 days still around 491, and negating a test down there isn't out of the question yet. So let's take a quick look at November beans, because I actually got to go and we got to do our WASDE recap webinar here in a minute. And I'll very well be doing something here tonight on the open because markets are moving and we need to continue to talk about this price action. Today was, for all intents and purposes, was just a day of pain for soybeans. We're still very much in a consolidative range. You can see the market had broken above the day's highs, broken below the prior day's lows early trade before the market opened, but we are, for all intents and purposes, still very much inside sideways price action in some kind of wedge structure. And you can make a good argument that we might be making an E wave if we do go above this high at 568, 570. I think at this point it would pretty much constitute a breakout higher. I really don't like that we came back down to settle the day below both the 55-day, the 18-day, and the 100-day moving average here again for soybeans. And a break of today's low, I think, would be a pretty clear technical level now that we have widened out the range for the week. We start to go below the low end of that range. We really need to be aware that that downside might come into play. To the same effect, though, above the highs of today, I think would constitute a move towards $14. Retest of our prior highs here in the month of July, and then why not up and away at that point? Particularly if we see the same type of demand we've seen out of China over the last couple weeks here, with 1.2 million metric tons now of flash sales coming in at 46 million bushels or something to that effect. That's some good indication that China is in here buying. So November beans on our 4-hour chart, and maybe I'll cover wheat and some other stuff tonight. We traded up, and if you see here, I'm going to highlight it. It's going to become purple here for a second, or blue. This 1363.75 full 50% retracement drawn from the 1418 highs to the 1309 lows. We came right up into that level, traded it, reversed off of it. We broke the short-term trend line. Arguably, this trend line we looked at yesterday, and it was kind of breaking it, failed to break above it, broke it again here today, failed to break above it. Okay, I'll put it up to this level, but it's really now aligning, in my opinion, with this this larger trend line drawn against the highs that comes in around 1376. So I like the idea now that if we can get above that level on this chart, we're bullish above 1369, bearish below today's low at 1323, and arguably the trend line support that we've been holding this last week. We talked about that yesterday, and actually last night it was starting to break below on that move below, right below 1333 here. We'll go down to like a 15-minute chart. And again, we were watching a channel yesterday for this market that news comes in, and it seems to always break any kind of technicals you were thinking about here. It's almost like the channel wanted to take out the low end of it, run stops, knock all the bulls and longs out, and then run up and take out any shorts above those highs. But we did get up, here to test the 1370 area, and have faded off of that high by 28 cents here into the close. Was not a good look, although we did remain positive on the day. You can, however, at least look at this also as a full 50% drawn from 1308 up to the 1369 highs. You can see how a 1339, the 50% level, that's this white line. Let me get rid of the channel, become a little bit clearer for you now. From that low to that high, we pulled back into the 1340 area, which is a 50% Fibonacci support. So we arguably now have two 50% levels that, if we break above 1380 and certainly break below the 1320 lows and break these 61.8 lines, whichever one breaks first, very likely, in my opinion, will be the direction this market will then go. So let's see. Hopefully beans don't decide to sit still and have just carved out another range here for the market. That's, of course, their prerogative and might be what happened here. Obviously, today's report with the adjustments we saw into yield and from the USDA was a lot more of a corn mover. Wheat was certainly benefiting from it, with a very positive day for wheat, trading up 19 cents for Minneapolis and closing up 26 cents there for Chicago's wheat in the September contract, making new contract highs, blasting through old resistance and out of the range we've been in. Was more of a corn and a wheat report than it was for soybeans, because the beans obviously are made in August. We've had good rain certainly through many parts of the Midwest here, at least through Illinois, to help make that and continue to make that crop. And I think beans arguably are waiting for that crop tour next week to finish up to see where bean counts really are and how stressed those beans are at this point in time. So keep an eye on things. It's still a sideways range for soybeans. I still favor with today's kind of fading that news report. unless we get a bid onto these markets here tonight and into the end of the week, that brings them back up into the trading ranges that we carved out to the upside in this news. That kind of fade into the close is something that doesn't sit well in a trader's stomach. And I've seen this movie. I know how it ends, and it oftentimes that fade the first, which is the news spike, go with the second, which is that sell-off to the downside, can oftentimes be that case. And I know no one wants to hear that we have a bearish technical development on the chart, even though things are fundamentally bullish. But again, I think it would be a buying opportunity for many of us if we see that sell-off come. Now, I'm not saying we can't head higher. I pointed out the levels on the chart where above these levels are definitely going to be starts of uptrends, but we haven't broken any of those just yet, at least for soybeans. To the downside, again, a move below 13, this $13.30 to $13 area. Again, that $13 mark seems like a very reasonable line in the sand, a psychological level we break below. Brings up into question a test at $12.40. And of course, below there, we could head down to $12 to $11.50, get that capitulating, hair on fire sell-off that this market likes to do at times, take us down for a couple weeks, make a harvest low, attract back all that demand out of China and from our other export partners, and away we would go to the upside. So, hope you've enjoyed today's commentary. You should definitely try to join us here in a few minutes, and we'll get those links and everything out there in here for our WASDE webinar coming up in just a couple minutes. Have a great day, everybody. Remember, you can always get in touch with me here at 312-277-0110 to check out everything we have to offer as a brokerage operation and as risk managers here over at Zaner Ag Hedge. Love talking with you guys. Leave your likes and your comments in the section below. And with that being said, have a great day, everybody. And we'll be back with you as price action develops.